Hello, everyone, and welcome. As always, it is a pleasure to have you here at another day of this Money Show Virtual Expo. Without further ado, please join me in welcoming Zachary Mans and Garrett Patton, Senior Analysts of U.S. Equities with ElliotWaveTrader.net. Now, to our live audience, please type any questions that you may have into the chat box. We'll try to take a few at the end, time permitting. With that said, gentlemen, I will hand the mic on over to you. If you need me, I'll be right here, but the floor's all yours.
Thank you so much, Charlotte. As Charlotte said, I'm Zach Manis, and with me today is Garrett Patton. We run the stock waves and the metals, miners, and agriculture service at ElliotWaveTrader.net, and also mirrored versions of those services on the Seeking Alpha platform. We're going to try and cram a lot into a short 30-minute window and also leave a little bit of time for questions. So we're going to jump right into it. We use Elliott Wave in order to analyze the world of stocks and the stock market, but we focus in stock waves, we focus on individual stocks and sectors as opposed to the broad market indexes, although sometimes we do contribute our thoughts based on the lens of what we see in stocks. But we're using the framework of Elliott Wave, and is a very, very simple rundown. We're looking at the manifestation of sentiment of extremes of fear and greed in fractal and repeating patterns. And those patterns we are easily characterized as motive patterns, which advance the direction of the trend, and corrective wave patterns that run counter to the trend and consolidate price. The two main versions of motive waves are impulses and diagonals, and we look for both. We don't shy away from any pattern. And those each have their own characteristics and play by some different rules internally. And I think one of the things that sets our Elliott Wave analysis apart is that we do focus on looking at things from multiple different time frames and being very careful, making sure that the subwave structure matches what we should be seeing to meet the premise at a larger degree. One of the major advancements to Elliott Wave that Avi Gilbert, the founder of ElliotWaveTrader.net, contributed was what he calls Fibonacci pinball. And that is a very, very precise way of looking at the subwave structure inside of a third wave, and then also for the corresponding fourth and fifth wave in a regular impulse, as well as some guidelines that work similarly for structure within a diagonal. This is not the focus of this presentation today, so we're just going to kind of skip over this slide, but I will let you guys screenshot this page, which allows you to get a quick access to the Elliott Wave theory and more information that we have in the free education section on ElliotWaveTrader.net. One of the things that we started focusing on a number of years ago in stock waves was looking at rotation opportunities within the sector ETFs from an Elliott Wave standpoint. This is a chart that a member of ours on the site, Rowan, has posted before. This is a 5-day view of the S&P 500 with another oscillating indicator over it. But down here is what really something that struck out that we started paying more attention to was the kind of ebb and flow as an oscillator of the different sector ETFs that are major components of the market as a whole. And one of the cool things that I saw that stood out a lot when I saw this was that in some periods of time, they were very, very spread out. And then often when we had market downturns, things tightened up a lot, and all of those different sector ETFs seem to condense and follow a much similar pattern, with very few places to really hide from different degrees of downtrend, but with a couple of notable exceptions with some things, typically things that we consider like XLU and XLP as defensive things, would sometimes lag a little bit behind the initial start of the downturn. So not really did they function as actual places to hide and avoid some of the downside, but they were things that played, that lagged the downturn longer and maybe did hold out a little bit longer. And then other sectors that started to show signs of bottoming sooner, and giving some early clues that things might trend a little bit higher and for longer. So this is an update of that same oscillator now. And as you can see, the recent price action that we've seen over the past couple of weeks off of the July high has had a lot of those things tightening up and into a more extreme zone where it seems like they're pretty oversold. Things can stay that way for a little bit longer. This isn't necessarily a bottoming signal for the market as a whole. But from this period of condensed performance of a lot of those sector ETFs, we can maybe start to see them start to spread out again and looking for additional rotation opportunities that can start to outperform on some of the next bounces or consolidations or whatever we decide that we should be getting as the next move in the markets. So we provide ongoing analysis in Stockwaves on hundreds of stocks throughout the day. Stockwaves is mostly presented as an integrated chat room that blends seamlessly into the markets room on the ElliottWaveTrader.net service, or its own chat room on the Seeking Alpha service. And we also present clear opportunities. You can get those as email alerts that we call wave setups. And these are carefully identified structures that have support, invalidation, resistance, and target levels. But we talk a lot about using layered methods for entries and exits. So these are not specific trades with one single entry, but generally showing targeted support regions and a path that we want to see price follow through on. We also post a charts of the day video on Mondays, Tuesdays, and Wednesdays, highlighting things that we see on usually 5 to 7 different charts. And on Thursdays, we have a live webinar, and we start that with a focus on a particular sector. And then we drill down into the component stocks. And then every 4 or 5 weeks, we do an overview of most of those sector ETFs. So this is just the most recent list of those sector watch videos, the webinars, highlighting the which sectors we've covered. So most recently, we did a sector review. Then we did transports, financials, technology, consumer staples, another sector review, retail, and consumer discretionary. And we're going to show you a couple of highlights from some of these looking back, as well as when Garrett jumps in and talking about what we expect going forward. I mentioned that we don't cover the broad market in Stockwaves because that's part of the market service or the market pinball wizard in those index charts that are covered in other services. But Garrett and I do keep a close eye on the RSP. That is the equal weight S&P 500. And this is a look back in November 2022, so almost coming up on a year ago, where we had what looked very much like a significant top and a 5-wave move to the downside, and we were looking for a larger bounce as a B wave that should fill out as a bigger A, B, C to the upside. There was some initial alternate risk that this could have been a 1-2 start to a more immediately bearish C wave, but we were looking for this region to hold the support in that lower 130s to head up higher and then fill out much more of a bigger flat for that B wave. This is a chart of Garrett's. He uses blue as always his primary color when he's posting his analysis on a white background, and he uses red to signify an alt count, but does not always provide one, only when it seems more abundantly necessary. So fast forward to today, and we filled out, instead of that ABC for the blue B wave, it looks like we filled out as a more muted WXY. So we got the bigger A wave, got an expanded flat for the B wave, but then failed to get a clear 5 waves up as a C wave, but looks much more like we have a potential top in place. So this is easily working on wave 1 of the C wave, but there is a chance that this could hold in the mid 130s, probably needs more of a 4th and a 5th wave lower as a wider flat for an alt wider B wave of an even wider B wave. But that's not something that we're looking at as a primary focus right now, but we'll certainly be looking for some of the individual sectors that might argue more strongly for that as rotation opportunities. So now I wanted to quickly run through some of the guidance that you might have seen from Stockwaves over the last year during that time. And so you can get a feel for how we present our analysis and adapt to the ebb and flow of those markets. So this was back in early November. So we were still seeing the broad market as just the early stages of the first half of what should be a bigger correction. And one of the clearest charts where we saw that potential was the technology ETF XLK. So we're looking for a bigger A wave and then a B wave into probably February, March time, and then a bigger move up as a wider flat into the 150s or higher into the summer. So this was back in November 2022. And certainly we got that higher move up for the larger A wave. And then into December, we got or early January, we got the bigger B wave. And then we're looking at a lot of things in the technology sector, and particularly a lot of the semiconductors, as being very bullish off of these December and January lows. So this is a quick snapshot of some of the wave setups that we posted from our table from back in December. We posted a number of them, including XLK on December 22nd, and a couple of other, the SMH Semiconductor Index, ADI, ONTO, TSM, as well as Google and Microsoft and AMD, among some of those other names that were bullish back there in December, posted as those wave setups. So this is just a quick snapshot of the XLK wave setup that we posted in December 22nd. As we saw on that other chart, it did get a little bit lower into the beginning of January, but held nicely as the B wave and got way more than our more moderate target at the 100% extension and the 618 retrace for that larger C of the B wave. Into February, we started seeing, we were looking for at least a small degree consolidation inside that C wave up in a lot of things, but it turned into a bigger flat for the B wave of that B wave. But we did add a couple of early speculative short plays, and many of those got nice moves down into March or even into May. But then in March, we started looking at bullish setups again. When we were holding that wider flat for the B wave, looking higher for the larger B, and some of those were a couple of the financials, Costco, PayPal, and Caterpillar, Amazon, Expedia, a number of other things. And then again in May, when we were holding a higher low off of that March low, is what we call a 1-2 setup in Elliott wave. Again, we posted a number of other bullish setups in the Stockwaves room. And these are all from the end of April and through May and beginning of June and July. This is one of those bullish setups. This is the IYT, the transportation index, showing that into the end of May, that 1-2 structure inside the C wave of the bigger B that we were looking for. And so this is one of the things that we are highlighting. This is one of the focuses of that Thursday's sector review, or not sector review, this Thursday's webinar focus. And a couple of those other names we pulled out from the transports index and a couple of other rotation opportunities. Into July, it had filled out most of that chart, but it did actually stretch up higher in July in more of this yellow fifth of a slightly higher B wave, all the way to, I think, 263 was the high that it made. And since then, it has come down quite a bit in what looks pretty clearly like the start to our C wave. To the downside. This is the XLF wave setup from the beginning of May. Here we have another use of that alternate color that Garrett has, which we were looking for. We set our target in this 35 region because even though we wanted to see more of a third, fourth, and a fifth of the bigger blue C of B that we were seeing in IYT and a couple of other structures, there was a risk that this was all of the B wave top and we were only going to get the corrective, more of a corrective bounce. So it didn't get all of the blue wave, B wave, the blue C, sorry, it did not get all of the blue 3 of C, but it did get more than just this red C wave bounce. So it could still count as the red wave 2 here. So we're kind of stuck in the middle where it didn't quite get all of this, but it got a little bit more than this. And now it's struggling to hold as the blue wave 4. But we did get that nice move in the direction that we wanted to see. Another bullish chart that we were looking at for rotation play back in March was XBI. We were looking for wave 1 of the C wave to play out as 5 waves up towards the 85 region. It didn't play out exactly like we wanted to see as a clear 5 waves up. It looked more like an ABC, so we were counting that as a wave 1 of an ending diagonal, just a different type of structure, but did fill out a nice corrective retrace into the July low. But its failure to hold this and then going on to break under the 76 level was very, very telling in terms of the weakness that we were going to see. One other highlight that I wanted to share with you guys before I turn it over to Garrett was the XLE energy sector. This is something that we've been very, very bullish on since mostly since 2020 and throughout 2021. But into May of 2022, we started to warn heavily that we were due for a pretty substantial consolidation as a larger wave 4. The ideal would be to fill out as a normal ABC pattern. And certainly we got a pretty substantial slide off of the June high that went nominally higher, but did not fill out all of an ideal C wave. We wanted to see it make one more low into the 73 to 70 region from this bounce in June into July, but failed to do that as the cleanest version of an ABC flat for that wave 4. So we are still looking for ideally some more consolidation, whether this is corrective bullish consolidation already in the start of the 5th wave, or whether it's going to still try a little bit deeper than that, but still holding a higher low as the E wave of the triangle. Those are the two primary outcomes that we are watching the closest. Oh, and real quick, we had, there were a couple of opportunities that we wanted to show for a possible early top in July. So a couple of things that argued more strongly for that being all of the B wave. And one of those was Microsoft. So this is a wave setup. We actually posted 2 wave setups for Microsoft on July 10th. One of them was a shorter term wave setup looking just for more of the wave 1 of a larger C wave. And then one was a larger years-long wave setup looking for more of the entire C wave off of that possible July top. And that has been filling out very, very nicely, possibly still halfway through the 3rd wave of that wave 1 that we're looking for. I think I'm out of time, so we'll skip over the short wave setup on XRT and XLK. And I'll hand it over to Garrett to talk about current rotations that we're looking for.
Thank you, Zach. If you could just unshare your screen so that I can take over. All right, hopefully everybody can now see my screen. I wanted to start off with a bigger picture view of the S&P 500 just to kind of explain where we think we are within this very, very large long-term count that actually goes back all the way to basically the Civil War here, where this bigger impulsive structure is starting from. This is the kind of the history of the S&P 500. So if you remember back to that very first slide of the presentation where Zach showed the motive and corrective waves, that 5-wave structure that progresses price in a larger trend, you can see that going back to that Civil War low, we have what can be that larger 5-wave structure in progress, this big super cycle degree wave 1 and 2 that bottomed that wave 2 at the Great Depression low. Then we had this very strong 3rd wave that has been ongoing since that Great Depression low that really we believe is coming to conclusion either in the very near term or even potentially already topped at the high that was made last year to set up the next higher degree correction, which would be the same degree as that stock market crash that we saw in 1929 into the Great Depression low. We don't think it'll be the same swift move to the downside. That's one of the guidelines of Elliott wave theory is alternation. So we think it could be probably more choppy, maybe even make a new all-time high in the B wave as an expanded flat, basically stuck in this large degree corrective structure for maybe the next 1 to 2 decades moving forward. So then I wanted to take a look at a few select sectors and how they match with that large degree count, this very large degree, this bigger picture view. So first up on industrials, going back to the same Great Depression low, we can see that same 5-wave structure to the upside that seems to be completing, arguing that same expectation that we could be putting in a fairly significant top to set up what could be a large decline next. So just wanted to kind of highlight that a lot of these individual sectors were not necessarily for the next 10 to 20 years viewing them as opportunities for significant substantial outperformance and upside. Consumer discretionary, same situation. It looks like that larger 5-wave structure at a higher degree off of the Great Depression low that potentially completed at the high that was made last year. So setting up the next large degree corrective pullback. Consumer staples, same situation, larger 5 waves up off of the Great Depression low. That seems to be completing, maybe not confirmed top yet. We could see a little bit higher near term, but otherwise getting very close to likely finishing that larger 5-wave structure. And even financials, a little bit different count here. It can be topping in a smaller degree wave 3, but still setting up a fairly sizable drop as that wave 4. But one sector that really stands out among all of these main sector S&P 500 sector charts is energy. Energy topped back in 2007, 2008 as what looks like a wave 3 and already got a very sizable correction into that 2020 low and has been turning up very strongly since in what looks like actually the new start to a higher degree 5th wave. So this is really the standout sector that we see going forward the next several decades as having the opportunity and really poised to outperform compared to the rest of the market. And it does look like, as Zach showed that smaller degree chart, that we can be working on a larger 5 waves up off the 2020 low, which can turn into wave 1 of that bigger degree 5th wave. So Zach already kind of went over the XLE chart, working on that 5 waves up from the 2020 low and getting ready to start the 5th wave, potentially even already starting that 5th wave, breaking out above the November highs, the next step towards confirming that. But near term, expecting a little bit of consolidation that we view as an opportunity to add to positions in the energy sector. It could be a deeper fade as that E wave within the wave 4 shown there in red. It could be a little bit more shallow, maybe hold the 200-day moving average if we have a bottom in place back at the May low already. XOP, similar situation. I have here the kind of upper support for that blue B wave potential between about 138 and 128. The red E wave can reach a little bit lower, but if we do see price pull back into that initial support range, I think it presents an opportunity to look for some long setups on individual energy charts or just on these ETFs themselves. Another sector that we see as poised to outperform going forward, and this again is a larger, bigger picture view, is mining stocks, gold and silver mining stocks. This is the S&P 500 gold index. It's another chart that has already seen a significant correction. In this case, it topped back in 1996 and filled out a wave 4 as an expanded flat into the 2016 low as what looks like a larger super cycle degree wave 4 and is working on a similar one to start to the wave 5. Now, we might not be done with the wave 2 yet. So we're kind of going to see what this next move higher looks like on some of these individual mining stocks. The potential for it to be just a wider flat B wave within that wave 2, maybe set up another leg lower before that wave 2 completes, but some individual charts can certainly argue for being more immediately and sustainably bullish in comparison. But NEM does seem to agree with that potential, and it is matching the same expectation that we have a super cycle wave 4 complete and prices in the early stages of that super cycle wave 5. So plenty of upside going forward the next decade plus, but it could be working on still the correction down from the high that was made last year, not yet complete, But we do think at least near term, we can get that wider flat B wave before potentially turning back down in the wave C of B or wave C of 2 there. And the final sector that we see some potential for outperformance, and this one's a little bit more immediate, is the travel sector. And before getting into some of the charts, I just wanted to quickly go over this little excerpt from one of Lynn's recent deep dive articles that she posts for the Stockwave service. She has a similar opinion, more based fundamentally, but she noted that higher interest rates put downward pressure on some parts of the economy while actually stimulating other areas. So who's on the receiving side of those interest expenses from the government? Consider an upper middle class 65-year-old retiree. They own a home outright with no mortgage, or they've locked in a low fixed rate mortgage. They have plenty of cash, money markets, bonds, and equities. They receive Social Security and Medicare. And as the Federal Reserve raises interest rates, as they have been doing, it doesn't really affect them negatively at all, or nearly as significantly as many other groups within the economy. And in fact, their bank accounts and money markets and T-bills start paying them higher yields. So they have plenty of money to spend on travel, restaurants, and other things. So there is kind of that fundamental background that really does agree with the charts as the potential for the travel sector moving forward to be an area of outperformance. So the subsector chart here, the S&P 500 Airlines Index, kind of stood out as looking like it does have some bullish potential. This larger five-wave structure off the Great Depression low not yet being complete, working on the cycle degree fifth wave and setting up further upside. The potential that we might not be done with a correction down from the 2021 high yet. We could see price see some more near-term weakness before that does complete and then sets up a trip back to new all-time highs again. Two charts that stand out within that sector, though. First up is Delta. We view Delta as one of the stronger charts within that potential, that 1-2 off the 2020 low. Again, it could also maybe still be working on that wave 2, fill out as a wider flat, come back down, retest the low that was made last year, slightly undercut that before it does set up new all-time highs. And Southwest is another strong candidate from the airlines index that has the potential for some nice upside going forward for the next even potential decade plus. It has been working on a corrective consolidation since the 2018 high as what can be a larger degree wave 2. So I tried to run that through all of that really quickly. Sorry if that was pretty fast, but I did want to save at least a couple of minutes for questions.
All right, that's perfect because we do have a few questions in here. I'll start with this first one from Joe. Let me know if this is something you already covered and we'll move on. He says, since it appears the SPX has hit the upper range of the target today, do you still see the market heading to 4,800?
That is something that is more covered in the main market service of our site. There are still some bullish counts that can be considered. So I don't think we've confirmed that price is starting to move that'll take us back down below last year's low yet. But that door is certainly starting to open. So we kind of need to see more information from price to answer that definitively.
All right, thank you. This next question is asking, are your tools incorporating AI? If so, what challenges are you encountering?
No, all our analysis is done by humans.
All right. Next, we have from David asking, your prediction for NEM was unclear. Do you expect a significant drop in the near term?
Let me go back to that NEM chart. So I do expect at least a wider flat B wave, so move back up in the near term, but the potential for that to then be followed by another leg to the downside. So there's near-term bullish potential, but the overall correction off of last year's high may not be complete yet.
All right, and we have a couple questions from Louise asking, what about healthcare and the biotech sectors? Do you have any comment on those? And here, I'll let you answer that first.
Sure. Yeah, healthcare is actually one area I was focusing more on the bigger picture charts here, kind of an outlook for the next decade plus moving forward. Healthcare is one sector, though, that could still see some more near-term strength going into the end of the year, early next year. I don't have the chart in front of me, but XLV is still holding a potential setup to take it to another high.
Thank you. And it looks like Luis and Carla both
Yeah.
are asking about uranium. Oh, sorry, did you have a comment? Oh, no,
I was
Zach's-
just going to say, in addition to IYT that I discussed, the XLV chart was one of the ones that we had posted at the end of May as that similar bullish one too, but it started to show some weakness in morphing into a diagonal structure in early August, and then it has been struggling to hold the support for that B wave, but it has not invalidated yet.
Thank you, Zach. And then I know we're right on time, but we did have both Louise and Carla asking about uranium. What are your thoughts on uranium? Is this a long-term play, and how much of a pullback do you expect near-term after this parabolic move?
We are bullish on uranium.
I think Garrett and I are both very, very long. Oh, go ahead. Sorry, Garrett.
Yeah, we're both bullish on uranium. We see what looks like a 5-wave structure off the 2020 low that completed last year. We're not yet convinced that the correction off of that high has completed. So we do see the potential that this move will stop at the prior high and maybe come back down to the lows that were made last year before resuming that large degree trend to the upside. So there is probably a better buying point than trying to jump in right here. But yes, at a higher degree, longer term, both of us are bullish uranium stocks.
All right. Thank you both very much. That was a fantastic presentation. We seem to get quite a few of those questions in there, even with just a couple minutes. So I'm glad about that. Now, to our live audience, we do have a lot more in store for you tomorrow, starting at 10 a.m. That is Eastern time. So be sure to tune in for another full day of fantastic sessions and great content. Until then, I hope you all have a wonderful rest of your day. Take care.